It is Wednesday, February 11th, 2026. And today, we are doing something a little different. We are looking at a ghost.
A ghost. That's a bit dramatic for a Wednesday morning, don't you think?
Maybe a little, but hear me out. We are talking about a company that you effectively cannot see.
Right.
They don't manufacture a single phone.
Nope.
They don't build cell towers. They don't sell TVs at Best Buy. And yet, if you are listening to this deep dive on a smartphone, or if you streamed a movie last night, this company was inside the device making it work. We are talking about InterDigital, ticker symbol IDCC.
Right. The invisible engine. And if you've been watching the market, this ghost has been making a lot of noise recently.
Exactly.
Yeah.
A ton of noise. The stock is trading around $363.90 as of this morning. It's hovering right near its 52-week high.
And they just announced a massive dividend hike.
33%.
A 33% hike, and they are sitting on nearly $1 billion in cash.
Which brings us to the big question, the one we're here to answer. Is this a hidden gem of the digital economy that is finally getting its due?
Or, considering it's at an all-time high, is this a stock that has already peaked? Has the train already left the station?
That is the mission today. We're going to strip away all the noise. We are taking a whole stack of SEC filings, 10Ks, 8Ks, the earnings reports that literally just dropped last week.
Wait, February 5th report.
We've got analyst notes from major firms,
Yeah.
some really dense patent landscape reports from a group called Gray B, and legal updates on all their patent litigation.
And we need all of it.
We're going to perform an objective, factual analysis to see if InterDigital is a buy or an avoid in this 2026 landscape.
And we have to be thorough. Because on the surface, this looks like a money printing machine. It really does.
Yeah.
But when you dig into the valuation multiples and the legal battles that are lurking in the background, the picture gets a lot more complicated.
Okay, so let's start at the beginning. Let's unpack this business model. I have to say, I love this concept. I call it the idea factory.
That's actually a fairly accurate description. InterDigital is what we call a pure play research and development company, a pure R&D shop.
Which means they get paid to think. That's the dream job, isn't it?
Essentially, yes. Here's an analogy that I think really helps. Think of the entire digital economy. All the infrastructure for 5G, Wi-Fi, video streaming. Think of it as a massive skyscraper.
Okay.
InterDigital isn't the construction crew that's pouring the concrete. They aren't the guys installing the windows or the plumbing.
Let them get their hands dirty.
Not at all.
Yeah.
They are the architects who design the foundational steel structure, the core blueprint that holds the whole thing up.
And so every time someone wants to build a new floor on that skyscraper, meaning every time Samsung or Apple or Xiaomi wants to build a phone,
They have to pay the architect royalty. Precisely. They have completely decoupled themselves from the messy, low-margin part of the business.
that's the key, the decoupling.
It is. They don't have supply chains to worry about. They don't have inventory rotting in a warehouse. Their inventory is intellectual property. We're talking about over 38,000 patents and applications. It's all ideas.
That sounds like a dream business. I mean, you invent the tech, the world has to use it, and the checks just come rolling in.
It is a high-margin dream, certainly. If you look at the profitability grades from our research, they're sitting at an A+ SAN. I mean, just look at these numbers.
What are we talking about?
Their gross margins exceed 88%.
88. Okay.
And their adjusted EBITDA margins, they're hovering around 70%.
70% margins. That is absolutely unheard of in the hardware world. Apple would kill for those margins.
Because they aren't hardware. They don't have the capital intensity of building a factory or buying raw materials. They reinvest roughly half of their recurring revenue back into R&D to keep that invention engine running.
To design the next skyscraper.
Exactly. But the rest,
Yeah.
that's pure cash flow. And that's what allows them to do all the things we're going to talk about later, like the dividends and the buybacks.
Okay, so we've established the concept. It's a high-margin IP powerhouse, an idea factory. But let's get into the nitty-gritty of the money, because that's what investors really care about.
Let's do it.
The recent earnings report, it dropped on February 5th, 2026. What are we looking at? What did the full year 2025 tell us?
So we are looking at a company in transition, but a very, very profitable one. For the full year 2025, total revenue came in at $834 million.
$834 million.
Now, if you just glance at that headline, you might say, wait a second, that's down from 2024, because 2024 revenue was $868.5 million.
And usually revenue going down is a big red flag. The stock would get hammered for that.
Usually, yes. But in the licensing world, context is absolutely everything. You have to understand the difference between recurring revenue and catch-up revenue.
Okay, let's define those terms because they come up constantly in all the analyst notes and the earnings calls. What's the difference?
Recurring revenue is the steady heartbeat of the business. It's the income from signed long-term deals where a licensee, say Apple, pays a fixed fee or a royalty regularly every quarter.
So that's the stable part. It's predictable.
It's predictable. It's what pays the dividend. It's the foundation.
Okay, and catch-up revenue. Sounds a bit more chaotic.
That's the lumpy part. As well, it's very lumpy. Sometimes a company uses InterDigital's tech for years without paying a dime.
They're just infringing.
They're infringing, they fight in court, they negotiate, they drag their feet for as long as possible. When they finally sign a deal or a court forces them to, they have to write a massive check for all the past usage. Sometimes that covers 3 or 4 years of back pay.
And that all hits the books at once.
All at once, a huge one-time payment.
So 2024 must have had a massive chunk of that back pay money, which inflated the total revenue for that year.
That's it, exactly. In 2024, they had significant catch-up payments from a big settlement with Lenovo and a few others. In 2025, they had less of that catch-up, so the total revenue figure dropped slightly.
But, and I'm guessing this is the key for a long-term investor, the underlying stable recurring revenue actually went up.
You've got it. The recurring revenue engine grew.
Do we have a number on that, on the recurring part?
We do. By late 2025, the annualized recurring revenue, or ARR, hit about $590 million. That is the engine getting stronger and stronger. It means they're relying less on these wild one-time legal settlements and more on steady, contractually obligated cash flow.
That sounds so much healthier as a business model. It's like moving from being a freelancer who gets a big check once in a while if you're lucky,
Right, feast or famine.
to having a steady, high-paying salary that you know is coming in every month.
That's a perfect analogy, and you can see that efficiency showing up on the bottom line.
Right.
Q4 2025 earnings per share, the actual number came in at $2.12.
$2.12. And what was the street expecting?
The Wall Street consensus estimate was only $1.13.
Whoa. So they didn't just beat, they almost doubled the estimate.
They absolutely crushed the estimates by almost $1 per share. That shows you how profitable that recurring revenue is.
And they ended the year with that cash hoard we mentioned. I'm seeing numbers between $900 million and a full $1 billion in cash and short-term investments on the balance sheet.
Right. Sitting on $1 billion when your market cap is around $9.5 billion, that's a very, very solid safety net. It gives them a ton of options. They can buy other companies, they can buy back more stock, or they can, raise the dividend.
Which they did, in a big way.
Yeah.
But before we get to the shareholder returns, we have to talk about where this money is coming from. Because the biggest story of 2025, the thing that really changed the narrative for this stock, was Samsung.
The Samsung deal is the anchor. It's the cornerstone of the whole bull case right now. For a long time, there was this huge cloud of uncertainty hanging over the stock.
Because Samsung is one of their biggest customers, right?
One of the absolute biggest. If Samsung had decided to fight them to the death in court, it would have been a disaster for InterDigital. It would have cost tens of millions in legal fees and frozen a huge chunk of their revenue for years.
But they resolved it. That was in July of 2025.
They did. The arbitration finally concluded and they signed a new license. And this isn't some short-term patch. It runs all the way through the year 2030.
And the value?
The total value of that deal is approximately $1.05 billion.
$1 billion.
Yeah.
From just one customer. To me, that validates everything, doesn't it? It proves that even the biggest giants in the world have to pay the toll.
It validates their royalty rates, which is the most important thing for a licensing company. It's a benchmark. If Samsung, one of the most sophisticated and powerful companies in the world, agrees to pay a certain rate,
It sets the price.
it sets the market price for the technology. You can then walk into a negotiation with a smaller company and say, look, Samsung is paying this rate. This is the fair price. You have to pay it too.
And speaking of setting a precedent, 2026 started with another massive win.
Yeah.
This just happened, January 7th, 2026. Xiaomi.
This was a huge win and arguably even more impressive than the Samsung deal because of how it happened.
How so?
So they renewed a worldwide license covering 5G, Wi-Fi, and HEVC video, all the key technologies. But the crucial detail, the part that made analysts sit up and take notice, they did it without litigation.
No lawsuits, no years of fighting in court and paying lawyers.
No lawsuits. Xiaomi just came to the table and signed. That signals a major shift. It suggests that the industry is starting to accept InterDigital's rates as the standard
Which lowers their cost of doing business.
significantly. Think of all the money they save if you don't have to pay a team of lawyers to sue every single one of your customers.
That is a huge deal. It really does feel like the tax on using their tech is becoming accepted.
Huh.
And they also signed LG Electronics in January, right?
Yep, LG is back in the fold. And on top of that, they're making this pivot we talked about. It's not just smartphones anymore. I saw a stat in the reports that their consumer electronics segment, that's things like TVs, IoT devices,
Non-home stuff.
all of that, that segment grew its revenue by over 230% in 2024.
230%.
That's the result of deals with companies like HP and TPV. It's proof that their skyscraper analogy applies to more than just phones. It applies to pretty much anything that connects to the internet or plays high-definition video.
Okay, so let's just summarize the bull case so far because it's pretty compelling. They are printing cash with 70% margins. They've locked in their biggest customer, Samsung, for years. They just signed Xiaomi without a fight.
Right.
They are diversifying into fast-growing areas like TVs and consumer electronics, and they're handing all that cash back to us, the shareholders. The board just raised the dividend to 60 cents per quarter. That's $2.80 a year.
Which is a 33% increase.
Yeah.
That is a very, very aggressive hike. It tells you that the board of directors is extremely confident in that recurring revenue stream we talked about.
Yeah.
You don't raise your dividend by a third if you think the money's going to dry up next year.
And they bought back over $100 million in stock in 2025.
$102.3 million, to be exact.
Yeah.
So they are returning capital through both dividends and buybacks, which is exactly what you want to see from a mature cash-generating company.
So hearing all of that,
Mhm.
it sounds like a slam dunk. It really does. Why wouldn't I buy this? It sounds like an absolute money machine.
Well, hold on. This is where we need to pump the brakes a little bit. A great business isn't always a great stock at the current price.
Okay.
We have to look at the valuation. And we absolutely have to look at the risks, because there are some pretty significant storm clouds on the horizon that could cause problems.
All right, let's play devil's advocate. Let's build the bear case. Why should an investor be worried today with the stock near all-time highs?
The first and maybe most obvious issue is just the price tag. As we said, it's trading at $363.90. The price-to-earnings ratio, the PE, is around 23 times earnings.
Okay, but 23x doesn't sound crazy in a tech world where some of these, AI stocks are trading at 50x or 100x sales, let alone earnings. I mean, look at NVIDIA or some of the big software companies.
It's not crazy, no. You're right. And in fact, if you look historically, InterDigital has traded at an average PE of around 30x over the last 10 years. So on a relative basis to its own history, it actually looks kind of cheap.
So what's the problem?
The problem is the stock price is at an all-time high, and the guidance for 2026 gave some investors pause.
All right, I saw that in the report. Management is forecasting 2026 revenue to be somewhere between $675 million and $775 million.
Correct. Which is a noticeable drop from the $834 million they just did in 2025.
And that's the headline number.
That's the headline number. Now, we know why it's dropping. It's because there's less of that algorithms, and the headline-reading investors, they just see one thing: revenue shrinking.
And they sell.
They sell. It creates a headwind for the stock. It scares people who don't take the time to understand the mechanics of the business model.
So the bear case is that the top-line growth looks like it's slowing down or even reversing, even if the underlying recurring engine is healthy.
That's part of it, but there's a much bigger risk than just the revenue optics. It's what I call the litigation minefield.
We said Xiaomi didn't sue, which was great, but not everyone is playing that night.
Not at all. Just this month, in February 2026, InterDigital filed new infringement suits against Hisense and TCL.
Two of the biggest TV manufacturers in the world.
Exactly. They are fighting over video compression technology, and those lawsuits are incredibly expensive. They're a drag on resources, and they distract management.
And you could lose.
And you could lose. That's the real risk. If InterDigital loses a key patent ruling in one of these cases, it doesn't just hurt that one deal with Hisense. A court could rule that the patent itself is invalid.
And if the patent is invalid,
And then nobody has to pay for it, ever again. That crumbles a major pillar of their skyscraper. It's a terrifying thought for them. If a court says, actually, this patent isn't valid, the value of that IP goes to zero overnight.
and then there is the biggest legal battle of them all, the one the analysts call the alpha play. It's also the biggest risk, the battle with Disney and Amazon.
This is the heavyweight championship fight. We talked about their pivot into consumer electronics and video. Well, InterDigital is now claiming that Amazon for Prime Video and Disney for Disney Plus, Emma, are using their core video compression patents to stream all that content to your TV.
Wait, let's pause on this because this is huge. They are actively suing Disney and Amazon. These are two of the most powerful and litigious companies on the planet.
It is the definition of high stakes. InterDigital is arguing that the technology used to compress the video files for streaming, specifically the HEVC standard, is covered by their patents. And since Disney and Amazon are the ones providing the streaming service, InterDigital says they owe royalties on all of it.
That is an incredibly bold move. If they win,
Mm-hmm.
what does that look like? What's the potential upside?
If they win, it opens up a massive, entirely new revenue stream for them streaming services. Management has put out numbers estimating the total addressable market, the TAM, for streaming and cloud services could be $500 billion by 2027.
$500 billion.
If they can get even a tiny, tiny slice of that, the stock goes vertical. It completely changes the valuation of the company.
But if they lose?
If they lose, that entire growth thesis evaporates. It's gone. And the market might punish them severely for overreaching, for picking a fight they couldn't win. It's a very binary outcome. Win big, or you could see the stock fall 20–30% as that growth story dies.
And there's also the concentration risk we touched on, right?
Yeah.
I mean, even with all these new deals, they still rely very heavily on a few big names.
Very heavily. Apple, Samsung, Xiaomi. If one of them decides to stop paying or drags out a renewal arbitration for 3 years, like Samsung just did, their revenue gets very lumpy very quickly. And beyond that, look at the names on their customer list. Xiaomi, Huawei, Oppo, Vivo. A huge chunk of their revenue comes from China.
Geopolitics, the China risk.
Exactly. It's always there, lurking in the background. If trade tensions between the U.S. and China escalate, or if the Chinese government decides to, clamp down on royalty payments to U.S. IP companies.
InterDigital is directly in the crosshairs.
Directly. It's a low probability event, perhaps, but it's a high-impact black swan type of risk. If China says, no more royalty payments to American firms, IDCC could lose 30–40% of its revenue overnight.
That's a scary thought. I also noticed something else in the governance section of the analyst report, something about insider selling.
Yes. In early February 2026, so just last week, the CTO, Rajesh Pankaj, and a few other executives sold some shares.
Okay.
Now, you have to be careful with this. Often this is just routine.
Right.
Executives are cashing out stock-based compensation to pay their taxes or, buy a boat. It doesn't always mean anything.
Okay.
But when insiders are selling near all-time highs, it's worth noting. It suggests they don't think the stock is drastically undervalued right now. If they truly thought it was going to double in the next 6 months, they probably wouldn't be selling, would they?
Probably not. Okay, so we have the bull case. Cash rich, recurring revenue is growing, massive Samsung deal locked in. And we had the bear case. The revenue dip in 2026, the expensive litigation, the China risk. But what is the moat? What actually protects this business long term? Why can't someone else just invent better tech and compete with them?
The moat is the technology itself, and specifically how that technology is woven into global standards. It's about the transition to 5G, 6G, and now AI video. You can't just invent around these patents easily because they are part of the very definition of how a phone works.
We hear 5G all the time, but is their 5G tech actually good? Or do they just have a lot of mediocre patents? I mean, quantity doesn't equal quality.
That is the quality versus quantity debate, and it's a crucial one. According to LexisNexis, and these are guys who rank these things objectively, InterDigital's 5G portfolio is among the top 7 globally for quality.
Top 7.
Not just quantity, but quality and essentiality. That means their patents are the ones that are truly fundamental. You literally cannot build a 5G device that complies with the standard without infringing on their intellectual property.
So you're sitting at the high table with the giants, with Qualcomm, Ericsson, Nokia, Huawei.
Exactly. They are in the elite club of foundational inventors. But for me, the really interesting part, the hidden gem in their portfolio, was the video stuff. The codecs.
Right, HEVC and VVC.
It's just alphabet soup to most people.
It really is. It sounds like alphabet soup. Can you break that down? What does that mean for the listener? Why should they care about something called a codec?
Think about streaming a 4K movie on Netflix or Disney Plus Sky. The actual file size of that raw video is absolutely enormous. A single minute of uncompressed 4K video is gigabytes and gigabytes of data.
The internet would just break up.
It would completely clog the entire internet. You couldn't do it. So you need to compress it, you need to squeeze it down into a tiny package to travel through the pipe, and then expand it back up on your TV without it looking like pixelated garbage.
That's what a codec does. It codes and decodes the video.
Exactly. And HEVC, which is also called H.265, and the newer VVC, or H.266, are the global standards for doing that. They are the mathematical formulas for that compression.
And InterDigital owns a significant chunk of the patents on how that math works.
A very significant chunk of the essential patents, yes. And as we move to 8K video, to virtual reality, to augmented reality, compression becomes even more critical. The files are getting bigger and bigger, so the compression needs to get better and better.
But here is where it gets really interesting, and this is looking to the future. The AI pivot. They just acquired a startup called DeepRender.
This deal just closed in early 2026. This is a fascinating and I think brilliant strategic move. It directly addresses what that Graebe patent report calls the two-track future of video.
Okay, let's break this down. 2 tracks. So track 1 is the normal evolution of the tech we have now.
Right. That's what the report calls ECM-enhanced compression model. That's just making the current math better. It's evolution, not revolution. It's doing what we do now, but maybe 20% more efficiently next year. InterDigital is a leader there, and that's their bread and butter.
And track 2?
Track 2 is the revolution. It's called NNVC, Neural Network Video Coding.
Using AI to do the compression.
Exactly. This is a whole different ballgame. Instead of a human engineer writing a fixed algorithm to say this block of pixels is blue, you have an AI, a neural network, analyze the entire scene, and figure out the most efficient way to represent and then reconstruct it.
And DeepRender specializes in this.
They're a leader in this field. It's a completely different approach. It basically uses a neural network to hallucinate the image back into existence at the receiving end using a tiny amount of data. It's like sending a sketch and having an artist perfectly repaint the Mona Lisa on the other side.
So by buying DeepRender, InterDigital is hedging its bets. They're betting on both horses.
Precisely. It's a brilliant hedge. If the industry sticks with the traditional coding path, InterDigital wins because of all their ECM patents. If the industry pivots and shifts to this new AI-driven coding,
InterDigital wins there too because they own DeepRender.
exactly. They are ensuring they own the toll booth regardless of which road the cars decide to take 5 years from now.
That is incredibly smart. It secures their relevance for the next decade. Because if AI video takes off and they didn't have a foot in that door, they would be made obsolete.
Correct. It's an insurance policy against their own obsolescence and a massive growth option if that track wins out.
But even with the best tech in the world, we keep coming back to the same problem, getting paid for it. We mentioned the term efficient infringement in the Bear case. Can we explain that concept a bit more?
Yeah.
Because it sounds incredibly cynical.
It is cynical, but it's a standard business practice for big tech implementers, the companies that use the patents. It works like this. If I am a massive tech company and you come to me and demand $100 million a year for your patents, I might just say, no.
Just flat out no.
Just no, I'll ignore your letters. I'll wait for you to sue me. That lawsuit is going to take 3, maybe 4 years to work its way through the courts. In the meantime, I keep my $100 million a year. I invest it. I earn interest on it. I use it for R&D.
So you're using their money to fight them.
You're using their money to fight them. And even if you lose in court 3 years later, the damages the judge awards might only be what you would have paid anyway, maybe with some interest. So efficient infringement is the cold, calculated business strategy of ignoring the patent holder until a judge literally puts a gun to your head and forces you to write a check.
That sounds incredibly frustrating for a company like InterDigital.
I think that
explains why they have to be so litigious all the time.
It is. That's why those wins against Lenovo in the UK courts and the successful arbitration with Samsung are so vital. They prove that InterDigital has teeth and that their patents hold up under scrutiny. But the real game changer, the thing that might finally kill the efficient infringement strategy, is happening in Europe, the UPC.
The Unified Patent Court. I've seen this mentioned in the legal briefings. Why does a new court system in Europe matter so much to a U.S. company that's suing Amazon?
Because before the UPC was created, the system was fragmented. If you wanted to block sales of an infringing iPhone or a Fire Stick in Europe, you had to sue in Germany, then you had to sue in France, then in Italy. Each country was a separate, expensive lawsuit. It was a nightmare.
Or a huge pain.
Slow and incredibly expensive. The UPC changes all that. It allows for a single ruling from a single court that applies across most of the EU member states.
So one judge can basically say, stop selling this infringing device in all of Europe.
Correct. That is a massive stick. It's a nuclear option. An injunction that blocks all sales in the entire EU is terrifying for a company like Amazon or Disney. Losing the entire European market is simply not an option.
And that's the leverage InterDigital is using in these new lawsuits.
That is the leverage. If the UPC issues an injunction against Prime Video or Disney Plus, those companies might be forced to settle very, very quickly. The risk is too high to keep fighting.
Okay, so the legal landscape is actually shifting in their favor. The efficient infringement strategy is becoming less efficient because the potential penalty getting kicked out of all of Europe is just too high to risk.
It certainly seems to be. The credible threat of a cross-border injunction completely changes the calculus. It forces companies to the negotiating table much, much sooner.
So let's zoom out. We've covered a lot of ground. We've looked at the idea factory business model, the high margins. We've crunched the numbers, strong cash flow, growing recurring revenue, but that optical dip in the 2026 guidance.
We've covered the tech moat. They're leaders in 5G, and they're making a smart pivot into AI video.
And we've looked at the legal war zone, the risks, and the opportunities there. It is time for a verdict. We promised the listener an answer at the top of the deep dive. Buy, avoid, or hold.
It really depends entirely on what kind of investor you are. I know that sounds like a cop-out, but there is no one-size-fits-all answer for this stock. It's too complex.
Okay, then let's break it down by investor profile. Let's say I'm a value investor. I like bargains. I'm following Warren Buffett. I like buying dollar bills for 50 cents. What do I do with IDCC?
If you are a strict value investor, this might be a hold or even an avoid right now. The stock is trading near its historical highs. The PE ratio is okay, but it's not screaming cheap. And that revenue guidance for 2026 shows a dip. A true value investor might look at this and say, the easy money has been made. I missed the boat when the stock was at $180 a year ago.
Fair enough. It's not a bargain bin stock anymore. What if I'm a growth investor? I want the next big thing. I'm willing to take on some risk because I want to see the stock double.
Then this is a much more intriguing story. The underlying recurring revenue engine is growing fast. That 33% dividend hike shows how confident management is. And the alpha, that huge unpriced upside potential from a settlement with Disney or Amazon, is massive.
That's not baked into the price right now.
Not fully, no. If they win those battles, the stock absolutely re-rates higher. Plus, the AI video angle with Deep Render gives you a credible long-term growth story that is just getting started. For a growth investor, it's a compelling, high-conviction play.
Okay, and what about the income investor, the dividend lovers who just want that quarterly check?
It's a mixed bag for them. The current yield is very low. It's under 1%. So if you need income now to pay your rent, this isn't the stock for you.
Oh.
But it's incredibly safe. They've paid a dividend for 16 straight years, it's well covered by earnings, and it's growing rapidly. It's more of a growth income play.
Yeah.
You aren't buying it for the 0.8% yield today, you're buying it because that payout just jumped 33%, and it might do something similar again next year. It's a dividend compounder for the long term.
What is the consensus on Wall Street? What are the professionals who cover this stock every day saying?
The analysts are, by and large, very bullish. The consensus rating is strong buy to moderate buy. They are clearly looking past that 2026 revenue dip and focusing on the ARR growth and the litigation potential.
And what about their price targets? Where do they see this going?
The average target is in the range of $412 to $425. Since we're trading at about $363 today, that suggests about 13% to 17% upside from here. And some of the more bullish targets go as high as $512.
So Wall Street definitely thinks there is still room to run.
They do. They seem to believe the market is still underestimating the strength of the patent portfolio and the full potential of that streaming revenue if they win those cases.
Okay, so final weighing. If you had to summarize the logic for our listener, boil it all down.
I'd say this. If you believe the digital economy streaming, AI, 6G, the Internet of Things will rely more on foundational patents in the future, then InterDigital is a structural winner. They own the land the skyscraper is built on. It's a toll booth on the future of technology. But if you fear a major market correction, or if you think the litigation against the streaming giants is a bridge too far and will fail, then the current price is risky. It's a high conviction play, not a set it and forget it stock. You have to watch the legal news.
Bottom line.
For the patient growth investor who understands the legal risks and has a multi-year time horizon, it's a buy. For the pure value investor who wants a bargain, it's a hold. The company has successfully transformed itself into a stable, recurring revenue machine. But you have to believe in that next leg of growth, the streaming and AI story, to justify buying in at these levels.
And that leads us to our final thought. Here's where it gets really interesting. I want to leave the listener with something to chew on.
I was thinking about Deep Render again, that AI acquisition.
Me too. We talk all the time now about AI generating video. You see tools like Sora, Runway, all these incredible new models. We are rapidly entering an era where video isn't just recorded by a camera, it's generated from scratch by an AI.
Right now, we use codecs to compress video that cameras capture. But in 5 years, if half of the video we watch is generated by an AI, purely from a text prompt and data.
And InterDigital, through Deep Render, owns the foundational patents on the neural networks that compress and transmit that AI-generated data.
Have we completely underestimated the size of their future monopoly? If they become the global standard for AI video transmission, the total addressable market isn't $500 billion from streaming. It's practically infinite.
Every single pixel generated by an AI on any device anywhere in the world might owe a fraction of a cent to InterDigital.
You might be watching this deep dive on a device, using their tech, streaming it via their codecs, and very soon the video itself might be generated and compressed by their AI.
That is a powerful and slightly scary thought to leave you with.
It certainly is. It redefines the potential scale of the opportunity completely.
Check the show notes for a link to that Grabia report with the breakdown of the ECM versus NNVC battle. It's a bit geeky, but it's really important for understanding the future. And as always, please remember, this is an educational deep dive, not financial advice.
Absolutely. Do your own due diligence. Know what you own.
Thanks for listening. We'll catch you in the next deep dive.